Stocks had a really good response today to that, to a relatively soft CPI. At least month over month, it was flat. The biggest drop month over month from one month to the next that we've seen since the 80s, right? So big time move in slowing the growth of this high inflation levels. Obviously, it's still persistently high. And some Fed expectations are still the same, some aren't. So I'm going to break that down. There's another day this year that looks very similar to today across multiple levels. So I'm going to talk about what day that was, you'll see why it's significant, and what it might mean to what happens to us going into the end of the week and then into next week and beyond. So I'm going to break that down today and have a pretty deep discussion on that. Again, a lot of similarities in multiple areas. So we'll break that down, and then we'll break down what's driving the price action. Of course, CPI, a big function of that. We'll look at different comparison charts, and then we'll look at our trade idea of the day, a stock that might be poised, similar to another trade we did recently in the market outlook on Target, might be poised for a pretty good move if the markets themselves follow through on what we saw today. So let's go ahead and get started. Today is Wednesday, August the 10th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. Hey, before we get started, I invite you to subscribe to our YouTube channel. Click that thumbs up down there and like our video. Comment on the video as well what stood out to you today. Join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we created. All right, if you're watching us here on our blog, come down here as check out some of these things over on the right. Also come down, click on the thumbs up on this heart, It takes you to this tab. Click that like button. Same thing here. Click on that thumbs up icon and click on this tab. Open up that tab, and click that like button. Again, the more you do that, it helps get our content out to all of our followers on those social media platforms. All right, as always, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator. We didn't get a cluster today, but we sure got a day that looks very similar to March 29th over here. As you can see, a gap. We had a good move going in. We actually came close to a cluster on the Russell a few days ago. We did get a cluster in the S&P a couple days before. We gapped up with volume. We were already pretty decently bullish on a short-term basis. Over here, we had a little bit of a pullback a couple days ago, but we had been bullish. A really good short intermediate rally we've been on going into what now looks like, and we were breaking through a resistance level at the time. We were breaking through what was at the time a 62% retracement. There we go. So whoops. Here, let's fix that because I hate it when it does this. There we go. So at the time, it was a 62% retracement that we had broken up above and looking like we were going to get to resistance and really get going to the upside. Well, that failed a couple days later as we filled in that gap within a couple of days. Obviously, now it's not the 62% retracement. We're still not above the 50% retracement of this big drop that we've been on, but we are breaking above this black line, which is a really important 23% retracement level. It's the retracement that started when we got below it here off of the COVID low point. So basically the last market sentiment rally, long-term rally we've been on. So we started to retrace it once we broke below it there, and obviously you end the retracement when you get back above a 23% retracement, or a bearish retracement when you get back below a 23% retracement line. So we are closing above it today with that gap, a very similar pattern to what we saw there on March 29th. A lot of today's gains, we rallied, 87 points today on the S&P 500? Well, if you look between the open and the close, you had about, 29 points? So you almost had 60 of those points, so those 87 occurred overnight. So by far most of today's gain occurred in the overnight session, with a very, very small range that occurred here of only 33 points during the day. So from high to low is only 33 points. So we're looking at, again, more than 50 points of overnight trading range. Again, that's mostly occurred after the CPI announcement on that earlier this morning. Incidentally, what happened here on March 29th, you had, if I recall there at the very end of March, you had the Russia-Ukraine it's kind of some peace talks as I was looking to try to see what was, what was really pushing things at the end of this rally. You had Russia-Ukraine peace talks that looked pretty positive. At the end of that day, I think the idea was that there would be less shelling around the capital city. So you had some pretty positive results, thinking maybe the war was ending. And you also had, incidentally, Shanghai starting their lockdown, their COVID lockdown that they had, that pushed crude oil prices down 9% that day. If you look at crude oil prices on March the 29th, over here, right? Right here. So you can see you had, these 2 days, and you can see the gap, the move lower. You had these 2 days of this big sharp declines in crude oil because of this because again of what was going on with the Russia-Ukraine peace talks, as well as Shanghai locking down, again, not using commodities. So the markets really responded pretty favorably to the drop in crude. Incidentally, today, crude oil rallied 1%, so not the biggest driver for risk appetite like it was then. Obviously, we know the big driver of the risk appetite was falling inflation levels, which ironically caused commodity prices to rise, which is what, the falling commodity prices over this past month is what brought inflation, down, at least the growth rates down a smidgen on a year-over-year basis. And so it's kind of interesting that, again, everybody's happy that inflation is softer than it has been, and that's because commodity prices are falling. So everybody gets happy and buys risk assets, which includes commodities. So commodity prices go back up, and this restokes the cycle again, especially considering they're already up as much as they are. Again, remember, we are 6% above the 30-day moving average, so more than we're close to the 97th percentile there. So it's not like we're coming off of a low point today. This would not be considered a runaway gap, needless to say. It has potential for being a breakaway gap. We did break above this old high point from back in June. So, the high point there, 41.77, and we opened today at 41.81, and the low was at 41.77. So there is some potential there of being a breakaway gap. Though generally speaking, when you get a breakaway gap, a resistance breakthrough, so to speak, it doesn't have to be 1.5 times the average volume, but you generally like to see above average volume. We ended up with just about right on the average. So it's higher than what we've seen the prior 4 days, but not any higher than the average. And keep in mind that average is really, really low. Like it's really come down, here at 67 million. From just where it was in July, and then of course where it was here at the end of May. Just in a couple of months, it's been cut in half, practically been cut in half. So volume has really declined. So to get the volume we had today would have been 50% of average just a couple of months ago at the same price, no less. At the same price. So the money flow, I've talked about the on-balance volume before, and how on-balance volume is just not really confirming a lot of this move, a lot of this bullishness that we've been seeing in the S&P 500. So you can see, there's the peak in non-balance volume from July the 29th. So we started this kind of 7 day where we were down 6 out of 7 days. So we're above that day's high point on the 29th, well above that day's high point. But on the on-balance volume standpoint, we're nowhere near that peak. And then when you look at the money flow, which kind of does the same thing as on-balance volume, but looks at it on compares it to the actual current price of the stock. So if you look at that using the closing value, the closing price of the stock, again, it's not nearly as close. And like I said, where we were back here in August, last June, so we're getting above that high point, and the money flow is nowhere near being above that. So we've lost a lot more money going down than we've regained coming back up on the upside during the rally. So a lot less money when you look at the volume times the price, even though the price isn't that much different from 360 to 400, or 420 is a small range. So there's not going to be a whole lot of difference here, but usually money flow will diverge a little bit from on-balance volume over a long term because of the different prices. But you get the idea that like this is a great day today. I mean, we're above a lot of these highs on the price level, but the volume level has just not been there, right? There's been more volume on this decline, on these declines combined than there's been on this one day of rally to a very, I mean, much bigger degree. So we're just not seeing that. Now you're starting to see like the McClellan oscillator we've looked at before. So there is some breadth to this that we haven't seen in prior rallies. We are easily above that 500 level now. The oscillator was declining. It did bounce back up to 54 today. You can see we were declining. So we'll see if this trend is a one-day pop and we continue to trend down on the oscillator. You can see you can do that, right? You can, when we're trending up, you're going to have spots to the downside. When you're trending down, you're going to have pops to the upside. So we'll see if this ends up being more than a one-day pop. We are above 600 now. I mean, that's a pretty decent sign from a breadth standpoint that we're turning to the upside. Obviously, you have a good bullish Hakunashi candle. You're not quite above the 40-week exponential yet on a Hakunashi closing basis, but we're really darn close there. And there's that 50% retracement that a lot of people are looking at to kind of be the sign that the correction is over with, right? Getting above that 50% level. That's been a pretty hot topic lately. You have 3 green arrows across the board. Not one of these major ETFs are showing a red arrow yet. Obviously, we came the closest on the MACD, which is generally the first red arrow. All of them turned back up. Every single one of them turned back up. So you're still easily 3 green arrows, though we've been 3 green arrows for a while, right? You're in a convergence. You know, that the MACD itself here is just barely green, right? It is at actually on this chart, it's for SPY, it's red. It's minus 0.03. So we actually have a red. The MACD is below its moving average on SPY. So and we're obviously still easily above the 17-day, way above the 17-day. So I mean, we're in convergence mode. This is, I mean, if you look at just how far above the 17-day we are, for the MACD to be below its moving average, and for us to be in the 90th percentile in terms of how far above the 17-day we are, goes to show that that's a pretty significant divergence between what the MACD is telling us and where price is relative to the same 17-day exponential moving average. So it's a pop. It's a great pop today. Getting above in a very important resistance level, in this case also getting above the bottom end of the value area. When you get in the value area, you kind of get sucked towards the point of control because that's where all the volume is. So getting in the value area is an important level too. We hadn't done that yet. So that's an important level. Of course, you got the 50% retracement right there. You got the 62% retracement of this intermediate run, which is also a resistance level right here, right above us. So we're poised to really make a significant breakout, but we're also poised to have some of this resistance kind of hold as we see again that we're at that level here on the 38 and 23% lines, but we're not breaking out. See, we didn't get above that high point on the Qs. We're not really breaking through. I mean, we're breaking through those lines, but we need to hold it and not be a fake out. Same thing with IWM. See, we got above these lines, all 3 of them sitting right on top of each other. We closed above those lines today. First time. This cannot be a fake out, because if it holds, great, it's really bullish. If it's a fake out, it's going to be really bearish, like the last fake out was over here on the Russell, where it looked like we were breaking away and turning around and really getting going to the upside, only to falter the very next day, fill in that gap. And again, that was March 29th, right? That was the mother of all fake outs there for the Russell, at least for this calendar year. We broke up above, it failed the very next day, filled in the gap in the next couple of days, and then you see what happened. I don't think that's going to happen again, but if we fail here and fill in these gaps, you're at least going to be moving towards these low points again and starting to retest some of this. Let's take a look at some of these other oscillators. So your directional movement index, above 35 on the positive, below, not quite below 15, but that's a good, you can see we're poised to get the dark green shading. Good sign. We never did get that here. We got the light green shading. We were briefly a dark green because we were coming off of a dark pink, but we were light green and never turned back into dark green here. But we're poised for that here. So really, really good sign from that perspective. The Ichimoku trend cloud, we are close to a mature bullish trend starting. We didn't get that over here in March. We're really close to that now. I think on the Qs, we are there. So we are above 5 and we are above 80 and we are above the cloud. So that's good sign there. And then like I said, IWM, we're not quite there yet either. And I mean, it's really, really important. Fake out potential. Like, again, I mean, today is almost a carbon copy of March 29th. March 29th failed. That doesn't mean this is going to fail. It just shows us what can happen if it does. So it doesn't, again, I'm not saying that it has to fail just because we look very similar like we did then, but it just kind of goes to show, you know, like we're breaking through major resistance by a little bit. If it doesn't hold and we fill in that gap tomorrow or Friday, or, you know, by the end of the week, if we can't finish, if we finish the gap by the end of the week, close the gap, then we've seen what can happen, right? We can see what can happen there. So that's your concern. Let's take a look at the Bollinger Bands, and let's look at the Keltner channels with the bands, because getting above the Keltner channel is a really significant deal too, because that's when you're trending, is when you're trending between these. We are back into the upper quartile. Remember, we never really did break above. We got a little bit of above 100% right there. Your momentum, which had turned down, turned back up here, but it's still very, very high. So we've seen this before too, where it turns back up at high levels. It didn't do that over here in March, but when we only got above the Keltner channel once with a really high Bollinger bandwidth. So we'll see if that ends up. The bandwidth is already falling as it is, which means that bottom line is starting to move up faster than the top line. Generally it's kind of hard to maintain that bullishness when you're already starting to fall. You like to see a lot of this bullishness occur when your Bollinger bandwidth is rising, and most of it, the problem is it took, you know, a good chunk of that rising bandwidth just to break outside the Keltner and a little bit outside the bandwidth. So that's the problem, is we used up a lot of this bullish momentum just to get to this resistance. How much do we have left to maintain a breakthrough here where there's going to be a lot of sellers, right? A lot of sellers show up at resistance levels, not because of they're perma bears, not because of some magical property of resistance and support, because a lot of people see a lot of the same levels that we're looking at, and they are programmed to either take profits or to look for some shorts, so for some bearish trades, knowing that they're at this resistance level. And when you get a lot of people suckered in, like we saw on March 29th, when you broke above those highs, when you get a lot of people suckered in thinking that you've broken through now and now we're going up, then you can see why we turn really bearish when a lot of that selling pressure is no longer offset because that's what it takes to break through resistance. There's always going to be selling pressure there because of resistance. So to break through it, you need to have more buying pressure to break it, and then you need to maintain that buying pressure to sustain it. Otherwise, you get the fake outs, and then the selling pressure just goes unabated because all your buying pressure were all pretty much suckered in and ran out, and then you got your fake out, right? And that's what we cannot see again by the end of. I mean, we'll know again most likely as soon as by the end of this week, if this is going to be a fake out or not, if we're going to be able to maintain this. All right, let's take a look at the volatility, the VIX, and we did close below 20 for the first time. We didn't, on March 29th was also, we closed below 20 on the 28th, but 29th we really got down. We actually closed below 19, and then a few days later we got to 18 and a half, and you can see where the VIX got to on a relative basis. Remember, the VVIX on those days was at 105, so that's where it was bottoming out. That's not the case right now, and the VVIX actually was really low. And on a day where the VIX really dropped pretty sharply, relatively speaking, relative to the VIX 3M, the VVIX actually rallied. And remember, when the VVIX rallies, that's actually bullish for volatility. And I need to remind everybody that we are in a seasonally bullish time of year for not only the VVIX, but also the VIX itself, right? This is a bullish time of year for the VIX. And so far, this is, from this point here is where seasonally we hit that bottom on the VIX. That's how low we are. That's how low we are compared to when that. So we're already, instead of being up, we're already pretty significantly lower. Again, going into even a more bullish time for volatility than what we typically see just here at the beginning. So pretty low VIX, and you remember again, the VIX is, and the VVIX for that matter, I mean, these are pretty low patterns. The VIX relative to like that 50-day moving average here, simple moving average, is down, at low levels. Again, about as low as we saw in March of 2009. So it's, a pretty significant drop there that we've only really seen, because it doesn't really go down as much as it goes up, but we've only really seen over here in April when we were coming off of this high spike, and we really dropped sharply to the 200-day. We really got below the 50-day pretty quickly. So we, again, we're pretty far below that 50-day moving average there, and we're dipping our toe under. So there's a lot of potential here for, I mean, it might not be exactly the very next day. Remember, it took 2 days for the VIX, for us to fill in that gap on the S&P and the Russell. You can see the VIX really didn't jump up too much on that filling in, and VIX went down a couple days after that. So it wasn't an immediate bounce up, but you can see that set the low point on the 29th. And again, if this is going to be like the 29th, then we are set up for this type of fake out move again, like we saw another instance of over here in February, where we broke below 20 by a smidgen, and it was a fake out move, and we rallied back up again. Let's check out the volume today, or the intraday move first. We did get above the highs. We closed with a higher high and a higher low. They both closed above. Both of those were above yesterday's high, both above last week's high. That's the gap that's really important to watch. Is this the breakaway gap, right? That's what we're wondering. Is this a breakaway gap? Even though we didn't get a whole lot of volume there, a lot came in there at the very, very end to help really push us to the close. But is this a breakaway gap? We'll know again as soon as either tomorrow or Friday. By the end of Friday, we should know if this ends up being a breakaway gap or not, if we end up holding this. And like I said, if it is, then we've got some good potential going forward, not just for like the next week or two, but like to the end of the year and beyond, right? That this, if we have really shifted investors, regardless of why, right? Who cares if the Fed should be raising rates, and you might think that this market is rigged and they shouldn't be going up. It doesn't matter, right? Why it's going up. All that matters is that investors are willing to take risk, and it's showing in a breakout move that hopefully by the end of the week is held. Then we've got, because as long as that risk sentiment's there, then we've got good potential for it to continue to be there, as we've seen in the other corrections, up to new highs within months, right? It's been a little bit longer this time, which is why I'm a little hesitant that this will hold, because we're already at about the 8-month mark, close to the 8-month mark, which is usually on a normal correction, we're usually already at all-time highs by the time we get to the 8-month mark. So the fact that we're not, and we're not even close, we're looking at maybe by the end of the year, if this is a correction low, that'd be a 12-month long correction recovery. That's a really, really long, which smacks more of bear market type moves, which means we may still have a move below the 200-week moving average to look forward to, if that's ultimately where we're headed. So again, like I said, by the end of the week, we'll really know. We'll have it down. What do you think? Do you agree with that? Do you disagree? Let me know what you think down in the comment section below. Do you think this is the breakout that holds and we're really headed towards new highs by the end of the year? Or are you in the fake out camp? Let me know down there, and what other charts or indicators you're looking at that we didn't show today that supports that, post those down there as well. All right, when I showed you this chart here yesterday, or Monday, excuse me, or yesterday in our class, it was interesting to see how IWM had really kind of pulled back to where all the other equity asset classes. It rallied today, but this time not alone. Monday it rallied alone. This time everything else came up with it. The Qs came up with it. Developed markets came up with it. Really, the emerging markets struggled despite a very significant drop in the dollar. That really kept emerging markets as an underperformer today, which is makes you wonder a little bit about that weak dollar move. Commodities did well. Gold did not do well. Again, very weak dollar, and gold didn't do well. Of course, gold's not a risk asset class, and so at least gold outpaced currencies, right? And it also outpaced bond. So from a risk asset standpoint, it was the best performer among the safety trades that you had there, thanks to that weakness in the dollar. But pretty significant moves. Let's take a look at how we view them. So let's look at gold first through its ETF. It had gotten above its 50-day moving average. Its MACD is also obviously dropping. You're hitting your head up against this resistance. Again, if this risk appetite holds today, then that resistance is going to hold too. So that will be another confirmation for us through the end of the week to see how things are going. Let's take a look at commodities, because what's interesting about today's move is that this month of really going from early June to pretty much through the end of July. There's the end of July there. You had a pretty good drop in commodity levels that's shown up in softer, in this case for July, softer inflation data. So the soft inflation data boosted risk appetite, and in that boost in risk appetite, you have an increase in commodity prices to breakout levels above moving averages here, above the 30-day at least. You still have to fill in the gap to the 50 because there is a pretty sizable gap. But you boosted commodity prices today, so that it's like a cycle, right? So weaker commodity prices over the course of time leads to softer inflation, bullish risk appetite. For whatever reason, the Fed's still raising rates. It's still widely expected to raise rates by 90% by 100 basis points. That actually hasn't changed. There's been a lot of focus on what's going to happen here at this current meeting in September 21st. But by December, by the end of the year, there's still a high probability. Let's go back to December. You can see it now. It's only 58%, and that's actually down from 68 that I saw earlier today. But there's a pretty high probability, 94%, that we're going to have a full 100 basis points by the end of the year. And that's what it was yesterday. We were at 97. So nothing's really changed from that perspective. So it's interesting to see how, that we have this risk appetite increase. But that's what it was. Softer commodity prices over time led to weaker, softer inflation. That's still, albeit very high, but softer inflation. And that boosted risk appetite, which led to higher commodity prices. Which is like, well, wait a minute. Don't we want falling commodity prices if we're going to have this narrative continue to play out towards a sustained bullish trend in the market and not just a fake out, right? Like we saw again on March 29th. So again, if this continues higher, that's going to be great for a short term. But if it pushes up into resistance on the S&P towards that next layer, that kind of last layer, then we can really have a fake out pattern. That'd be probably even worse than just having your toe across, some of these levels. Like I said, if I were to go back over here to this chart, it's one thing to have a fake out right here, just when you're just a smidgen above this line, and kind of like that, and you can see what happens. But if we were to really get up towards like this last layer of resistance, the 62% long-term level, that's 78, so right around 4,400. If we get up there and fail there, and then drop our way back down towards 4,000 and below, then that's going to be way worse because we'll have more people sucked in than we have right now. And we still have a little bit of room here before we clear other major hurdles, that 50% retracement of the long-term drop, the 62% retracement of this current intermediate drop that we're on right now. So that's kind of the idea about the commodity prices is, we don't know necessarily that we want them to be as bullish as they were today on this increase in risk appetite. Here's the drop in the dollar. So you had your failure here at the 17-day. Everything's rolling back down. Remember, the issue here with the dollar versus the yen, it's one thing, the yen's considered a safety trade, right? This is a nice little breakout on the euro, though. You did close, despite a pullback, you did close above a bunch of highs. We did not close above the 50. It would have been nice had we closed above the 30 and the 50 today. That did not happen, so we're still some resistance here. But breaking, remember, the markets were bearish this year on the strong dollar. If the dollar starts to weaken, is that going to be bullish for risk appetite? Usually the euro kind of rallies along with risk appetite. And that's a traditional correlation. So we'll see if that continues to play out over the course of the second half of the year, if we actually do get a move back up to all-time highs again by the end of the year. So the yen kind of had a bigger move, a bigger drop. The dollar had a bigger drop against the yen than against the euro, as you got this big gap between the 50 and the 200-day moving averages that we haven't seen yet on the euro. So if you look at just the ETF or the S&P, you're flirting, or with the dollar, excuse me, you're flirting with kind of long-term retracement level support and the 50-day. So fake out or not. Again, we'll know more by the end of this week if we're able to sustain this bearishness and break support and get into this value area to the downside, or hold support, get back above this 50-day kind of with a fake out type move and fill that gap in. Really, really important to watch through the end of the day, end of the week. Long-term bonds, kind of same thing, right? It's flirting with a divergent move to the downside, getting below the 17-day MACD, below its moving average. But yields, you can see, are not necessarily the most bullish, and we'll see, for this bullish narrative to occur, if the Fed not to raise rates, that's going to have an impact on yields. But remember, the yield spread is still as bearish as it's been, so that hasn't changed yet. So that's still an issue in terms of what that's telling us from a bond market standpoint about where the markets and the economy and broader risk appetite is right now. All right, now let's take a look at our trade idea of the day. I want to take a look at Juniper Networks. Dark green shading, the green line today. Big kind of a nice little breakout move. Not a huge breakout move. Obviously, you had a really negative earnings report that you opened up, but then it rallied all throughout the day. Stayed pretty inside of the gap until today. And then today you closed above a lot of days highs, multiple weeks worth of highs here with a good move to the upside, 1.5% above the 30-day moving average. So it's the first time, you've had other days where you've rallied above the 30-day. This is the first time that we've been in green shading, right? Green shading and a green line. You also have 3 green arrows on Juniper. You can see it's not the first time for 3 green arrows, as we were over here, remember, but this is the first time that the intermediate line is also now above 50 and rising. And so 3 green arrows, dark green shading, and green lines, a good combination from a bullish standpoint for the markets. You can also see too, there's a lot of potential to the upside. If the broad markets do break out to the upside, kind of like the target trade that we did previously, there's a lot of potential. The PPO is still low. It's just barely starting to rise this week, but it hasn't we don't have that bullish candle yet. We haven't got the green arrow yet. At least you do have a positive differential there. The DMI is not set to break out. In fact, the negative is still above 25. But at least you're above 20 on the positive indicator. When you look at the Ichimoku cloud, you're still below the cloud, but at least you're above the blue and green lines, and we are starting the inklings of a bullish trend. You still haven't really started one there yet. The RSI and the CCI, you're not getting into bullish territory, but you are getting some pretty good breaks above 100, above 50 together there. So you have the makings of what could be a pretty decent move on Juniper, especially if we were to get into this volume gap. If we were to break through, you have a very low bandwidth. It's set for a breakout pattern. It's way inside of the Keltner channels. You can see the Keltner channels are pretty wide. You can see there's really been no momentum, very, very small momentum. You have to kind of zoom in to even see anything. But you're getting some bullish momentum right now. You're still red on the candles. So again, you're set up for a breakout type move to occur, one way or the other, right? Obviously, it didn't work out on the earnings report. Then now you're set up for what may be a breakout move to the upside, especially if the markets move up. You see the break up to, we were at the you had a pullback at the end of the day. When we were doing this during Market Outlook Live, you were above that 50-day moving average. You can see the point of control is below us now because of the move. You did break above the 8, 17, and 30-day moving averages today, and you're that close to breaking above the 50 as well. So there's a lot of good potential here for to fill in that gap, especially considering the lack of volume and then some. Again, if the broader markets themselves are moving towards a bullish opportunity. So this will give us a chance to do more of a directional trade since it's got so much potential left. So I decided to do a long call option, just buying the at the money long call option. So buying the 29 with a 50% stop order. So putting a normal risk on this of, again, with the stop order would be about $500. But if we do really kind of break out and get up to this kind of like 34 level area, then you can see we can get about a $3,000 reward for that $500 of risk. So really good reward to risk ratio. And if it doesn't work out, then at worst case scenario, we end up losing $500, and more than likely we'll end up losing a couple $100, which I would more than willing take for a potential reward if the chart plays out of $3,000 on that few $100 of risk. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Apply to anybody else's thread. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. Also, subscribe to us at marketscholars.com for free. Like us on Twitter and Facebook. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.